inventory and other internal controls for your company. And as we get started, this emanated from a discussion and a program we did last year on fraud. And here at the beginning of today's session, I'm going to take just a few minutes to kind of review the topic of fraud and the aspects of it to see how it connects and relates to the inventory and other internal control areas of the company we're going to talk about this afternoon. So in the time we have together, we're going to just briefly review the definition of fraud and talk about the fraud triangle and the behavior and warning signs for fraud. And then we're going to get into the inventory management, internal controls that you can develop and implement, and the things that you should be watching out for when it comes to your company inventory and ordering systems. And then we'll also get into other areas of internal control in a company. We'll look at, briefly touch on payroll, accounts receivable, cash coming in, and then accounts payable, cash going out. And then we'll wrap it up with questions and answer session at the end. As Wayne said, if you do have a question as we go along, just type it in that box on the right, and we will get to it towards the end of the program. So first, let's look at the definition of fraud. Just as a reminder, it's an intentional act meant to deceive others and either results in the loss to the victim and or the person committing the fraud achieving a gain. And there's three legs to what they call the fraud triangle. So it's a three-legged stool, and if any one of these legs is missing, then you do not have fraud occurring. And the three areas are: you got to have a motive or a need, you have to have a rationalization for committing the fraud, and then there's got to be an opportunity to commit the fraud. So with the need or the motive, you've got a lot of external influences. You might have a drug or alcohol program. The problem, the employee or the individual could have some health issues. They could be just not happy, could be job dissatisfaction, or there could be some other outside financial pressures that are outside the control of the person that they're dealing with. They could be in debt over their head or something like that. But that's the first leg, is the motive. And then you need the rationalization. And the rationalization gets to, okay, well, I'm just going to borrow the money. I'm just going to borrow this inventory that I'm stealing. I'm going to replace it, when I get a chance down the road after I get this money from the side job that I'm doing. Or they say, oh, you know what? I see the owner doing it. I see the owner take materials out of the inventory. What's the big deal? I can do it too. Or you know what? They owe me. They didn't give me I should be making more money than I am. So they, in this case, would take the inventory or cash or whatever, and that's their justification for it. Now, of the three legs of the triangle, the only one that the owners, the company, have control over is the opportunity. Okay, that's the only one that the contractor has the ability to control. Okay, can't control the motive of the individual that's perpetrating the fraud or attempting to perpetrate the fraud. You can't control the rationalization for it. You can only control the opportunity. And that's what we're going to talk about this afternoon, is ways to minimize the chances for the fraud by controlling their opportunity to commit it. So with the opportunity leg, it's a matter of safeguarding your assets, and you want to institute internal controls, or we're going to talk about those kind of things that are going to reduce the chances for fraud to happen. 5%, according to the most recent report to the nations on fraud from the Association of Certified Fraud Examiners, 5% of the U.S. gross domestic product is lost annually to fraud. That amounts to $820 billion a year. Now, if you're sitting here in this webinar this afternoon, and maybe you're a one-man shop, or you just have 2 or 3 trucks, and you look at that number and you say that's huge, and oh wow, that's a huge number. I'm a small guy. That does not impact me. You know, my little company, I'm not impacted by fraud. I hate to tell you, but you're wrong. Because the average loss due to a fraud in a company with less than 100 employees is $154,000. Now, that's not just a fraud that occurs, you know, in stealing fittings or inventory. You know, a lot of those involve, you know, forging checks and those kind of things. But the little companies, in this case, companies under 100 employees, still are subject to fraud. And the average fraud in the report is $154,000. Now, my question to you is this. You're a company that does $1 million in sales a year, and you are a victim of $154,000 in fraud. How likely are you as a company to survive versus a company that, say, is $10 million in sales? That's why fraud for the smaller companies has such a much larger, in many cases, devastating impact. Because a lot of the small companies that I know that do $1 million in sales, they might even be 15, 20, 25 years into the company, into their business. If they have that kind of amount, $150,000, $200,000 built in owner's equity, you know, that wipes it out right there. So I guess my point there is I just want you to be aware of don't think it can't happen to you, because it can. Very briefly, as I just kind of said, it's, you know, small companies are susceptible to fraud just as much as the larger companies are. We do not, as the smaller companies, we do not have the resources that Kohler's and American Standards and Moen's have to set up systems and have the staff needed in order to separate the duties that will minimize the chances of fraud to happen. And that's because we are so much smaller and have much limited resources. It's more likely to be detected by tip. It's like how it's going to be found out. More likely that you're going to have employee A telling you, hey, I saw employee B take 3 InSinkErator disposals out of inventory last night and put them in his personal vehicle. So tip from a fellow employee or a customer or a supply house, a vendor, that's the most likely way that you're going to hear about fraud occurring. And the biggest issue, going back to that $154,000 number, is it says here, nearly half of the victims, they don't recover any losses that they suffer due to fraud. And in most of the cases that I've been made aware of, little to none of the money is recovered because the people have spent it. You know, if you've got a drug or alcohol problem, or if you've got a gambling problem, that money's all gone. You know, it's vanished into thin air. One last note on fraud: they all start small, and they get progressively larger the longer it goes along. Now, why is that the process? Well, most people aren't too aggressive to begin with. You know, if you've got, you know, if you're not maybe locking up your inventory, or you don't have cameras or something, so somebody says, well, you know, I'm going to just take a garbage disposal, or I'm going to take, you know, some handful of fittings. It's not going to be not much, just to do this little side job. They won't care. And they do it, and they don't get caught, they don't notice anything. Well, then you start to get more emboldened. That's the same way whether it's petty cash in the office, or ordering things from the supply house, you know, maybe padding a invoice, or taking money out, your service technician or somebody in the office swiping a cash payment from a customer, those kind of things. The more opportunity they have and the longer it goes undetected, then they get more arrogant. Maybe isn't the best word, but they start to get kind of cocky and emboldened. Hey, okay, look, they didn't notice. You know, they're too busy with this or that. And it goes on for a much longer period of time. And typically they get caught because they get too greedy. So just a couple red flag indicators to watch out for, whether it's an employee, it's a client maybe that has access to your property, or supply house personnel. people living behind their means and the facing financial difficulties. Those are the two biggest ones. If you notice the third one on this list, I know it's a tad hard to read, but the third one down, unusually close association with the vendor or customer. And we'll talk about that a little bit in the inventory controls. Somebody working in a technician working with a guy behind the counter at the supply house maybe, and they're in cahoots to maybe set up their own little side business or take materials either from the supply house and or from the contractor, using the supply house personnel to assist them do that. And there's a whole list of these. I'm not going to go through these detailed because it's not the primary purpose of this afternoon's program. Just a reminder, though, as Wayne said at the beginning, you'll have access to these slides, so you'll be able to review them later in more detail at your leisure. So some warning signs to look out for. Shortages of cash coming up missing. Invoices from suppliers that don't look familiar, questionable purchases, missing altered forged documents, company material expenses going up all of a sudden. Geez, normally our materials are about 18% of our sales. Now it's 23%. What's going on? Falling company revenue, same thing. And I'll talk a little bit more about that material percentage, the example I just gave, a little bit later in the program. I've got a slide or two that I'll explain it more. So here's the section of the assets and the fraud schemes that we're going to look at this afternoon. Mostly relating to inventory, but it also relates to other company assets. So you see inventory, you could also consider capital assets, your trucks, your accounts receivable, your cash accounts, those kind of things. And this slide just shows you a few different types of fraud, misuse of company property. Larceny is, outright theft, and then it shows a couple different ways below that on how inventory could be the schemes that could occur and the internal controls that we want to implement to prevent or not prevent, minimize the chance that they're going to happen. I guess that's a point that I should reiterate that, and it's stated right here. Okay, there's no way we can guarantee fraud will never happen. Okay, we just can't. It's one of those things where you try to get to perfection. You get closer and closer, and the decimal point gets smaller and smaller, but it's still far away. Okay, so we can never completely eliminate it. We do our best that we can to minimize the risk, and we have to balance minimizing the risk of theft of inventory, let's say, of happening versus the cost to implement that internal control. So cost of prevention versus the cost of cure. And normally, in most cases, the cost of the cure, which is recovering the losses, is much higher than the prevention cost. So better to prevent it rather than detect it and then deal with fixing it. The most effective internal control that we can implement into our company, not just for inventory, but any internal controls, is the separation of duties. And the separation of duties essentially means that you require more than one person to complete a task. Okay? So let's take, inventory control, for example. At the bottom of this slide here, the person responsible for ordering the inventory shouldn't be the one to receive it and check it in. Well, why do we want to separate those two functions? Well, if I'm ordering the material and then I'm the one that receives it and checks it in, I could be ordering, personal items or, items that aren't necessarily authorized. So if I'm the one doing the ordering and receiving it, then, I've got a way to scam the system. Or there's something ordered on there, and let's say we order 10 toilets. And I check in the toilets, and I put 2 of them in the back of my truck. And, when nobody's looking, nobody's around at the end of the day or something, I stash 2 aside. And I check them in, oh, yeah, we got 10 trucks, or 10 toilets in. If we're not properly tracking our inventory through our records and the computer systems that we have access to, even if it was a manual record keeping, but if we're not monitoring this, that's how these things get happen. So I walk away with 2 of the 10 toilets, and the company's got 8 toilets, but they paid for 10. So we're trying to separate the different aspects of a transaction, okay? So accessing an asset, recording a transaction, and approving it, those are the things we're trying to separate or segregate. The problem we have with our smaller companies, especially with the family businesses where, maybe it's just you and your husband or you and your wife and 2 or 3 plumbers or even 4 or 5 or 6 plumbers, there's not enough employees to separate all those duties. And so that causes a problem. So how do you, so you go ahead, okay, well, we're going to add another person in the office to cover and protect our cash, accounts receivable, and our accounts payable. Well, so now all of a sudden you're adding, depending on what else you're going to have this individual do, you could be adding $25,000, $35,000, $45,000, $55,000 plus benefits onto your company payroll, and in this case your overhead. Well, a lot of companies are not in a position to take that on. So you have to look at the increased protection from fraud occurring, theft of the materials or cash or accounts payable, what have you, or any physical assets a company has, versus the increased cost to add that second person in the office. So you have to balance those out. And sometimes the cost to, or sometimes the benefit of reducing that risk of inventory being stolen is less than the increase in cost to the company by adding, say, a warehouse person or something. So you always have to look at that as to, you're always going to look at cost-benefit analysis, essentially. Inventory shrinkage. This is a term that's important to understand. Inventory shrinkage, well, what does that mean? Well, it means that the inventory that we actually have does not equal what our accounting records show, whether it's in our computer system or we just keep manual records, we do a manual count. Well, okay, so our software says we should have 10 50-gallon water heaters in stock, and I go out into the shop and I only see 7 out there. 3 are not, they're not on the trucks, they're unaccounted for. Well, that's poof of smoke there on the slide. What happened to it? It's gone. It's shrinkage. In our industry, it's not unusual to have some inventory shrinkage, but if we're talking percentage-wise, it really should be less than 0.1%. It's a really small percentage and a small dollar amount, even for a larger company. If that number starts to get larger, or that percentage is larger than that, you very well may have some kind of funny business going on there. You might be have somebody stealing from you. So I took this picture. This is a picture out in our shop on the floor, a couple fittings, and toilet supply, 12-inch toilet supply. Pretty innocuous. It doesn't look like a big deal. If I asked those of you in attendance that are owners of the company, I think I know the response I'd get to that when I say, when you see that, what does that tell you? Versus maybe an employee in the office or a technician that might see that on the floor out in the shop and just notice it and just keep walking. They don't think like owners do. Well, how long? That's actually about $5 our cost worth of material laying on the floor. How long would that lay on the floor if that was a $5 bill? Not very long, right, compared to the material. And the point I make there is it's not just, material being stolen. It's, they don't necessarily perceive the cost or the value of it. That, oh, it's just a little bit of material. It's not a big deal. I just took, I just took a couple fittings or whatever. Well, you know, that's a couple fittings. Well, what if it's a garbage disposal? Now that's a bigger dollar bill, et cetera, et cetera. So I want to make the connection of the actual dollars, you know, the copper fitting compared to the actual dollar. That is, you know, whether it's a 3/4 inch 90 sitting on the floor or money, I mean, it's essentially the same thing. You just can't make your payroll with a 3/4 inch 90. You need the actual cash. So let's look at some specific things from the inventory standpoint that you can do to reduce the risk of inventory shrinkage and theft, what have you. The number one inventory control that you can do is lock it up. And it sounds really easy, but for a lot of our companies, it's not quite as easy as it sounds. But if you restrict access to the inventory, that is going to reduce the chances that you're going to be subject to fraud, you know, subject to people stealing from you. The problem, again, for the smaller companies is, okay, well, so I can't afford to have a warehouse person. So we're not big enough to be able to have a warehouse person on our overhead. So what do? Well, you can still have, if you have an inventory area in your shop, you could still lock it up and restrict access to it to, you know, maybe a manager or something like that. You can also install security cameras. So maybe you don't lock it up, but you have security cameras on your inventory area, so and you let people know they're being watched. Just that alone, setting up, say, a security camera, letting people know that you're going to be watching them, holding them accountable, that in itself alone is a deterrent to theft. It doesn't mean that it won't happen, but it helps deter it. So if you can lock up your inventory, you definitely should do that. But if you can't, you at least need to restrict access. Another way that you can protect your inventory actually is to reduce the amount of inventory you need to carry. You know, if you have less on stock, less available, and I'm not saying you short yourself from the standpoint of where you can't, you know, so now your trucks don't have the proper inventory and those kind of things. But if you're only, say, you're only selling 5 garbage disposals a month, there's not really a need to have 20 in stock. Even if you were to get really good pricing on that, that gets back to the screenshot of the few fittings versus the $5 bill. You know, you've got to remember when you're looking at your inventory, that's a bunch of dollars there, and we don't want to have more money tied up in inventory than we absolutely need to it, because that money, the actual cash itself, is better invested in other aspects of our business. We don't want it tied up, like I said earlier. You know, you can't make your payroll by handing out 3/4 inch 90s or whatever. So the less money we have tied up in inventory, the better off we'll be. By the same token, that's why it's important to keep an eye on it and monitor it and lock it up if you can. If it's not practical to lock it up, restrict access as best you can. Security systems, installing cameras, pricing has come way down on those, so they're not nearly as expensive as they were, say, 5-10 years ago. So lock it up is the first one. The next thing that you can do with your inventory to reduce the chances of being a victim, you know, of fraud or having it stolen, organize it. This is a pretty iconic truck and picture, and George Brazil was a longtime member of the PHCC. He was one of the first to come up with a truck inventory system, and this was a picture that he always shared with everybody. And it's a perfect layout of what is on that truck. Now, that could be a truck, that could be your shop inventory, but right there it's got exactly what that truck's going to have. So it's going to have 2 water heaters, 2 toilets, you know, 10 3/4 inch copper 90s, what have you, but there's a specific number and there's a specific layout for everything. it's a lot easier to see what you have and don't have if you've got it organized and labeled and set up in bins, etc. So having a standardized truck inventory, having a standardized shop inventory, a layout of shelving with bins and quantities, minimum and maximum numbers of each part, setting those numbers and having those numbers, that's another way to reduce the chances that you will be, that your material come up missing. So if you have a truck set up and you're doing regular, even if you have your computer system set up where your technicians are mobile and they're using iPads or some other device and barcode scanners, you still every once in a while do a physical inventory. So if you go out and the truck is supposed to have 10 3/4-inch 90s on it and you've got 15 on there, you got a problem. Or there's supposed to be 10 and there's only 8, well, you got a problem that way too. But if it's not organized and you don't have a inventory system per se in place, you won't know what you have and don't have. Now getting a little further into this, well, how do we control our inventory levels, our ordering levels, those kind of things? All about having processes and procedures in place. If you don't have a system of purchase orders in your company, even if you're a smaller 1, 2, 3 truck shop, I highly encourage you to do it. It's not really difficult. Even if you do it, simply as a manual yellow manila sheet of paper and you list numbers down and you have a sequential order of numbers and you require all orders with any of your suppliers to have a purchase order number. And if it doesn't have a purchase order number, you just let the suppliers know this is our company policy. If there's no purchase order number assigned, then we are going to refuse. We're going to refuse to pay it. And you can get as high tech then, again, with the mobile systems where you could have purchase order done electronically. But you need authorization. So, so who is ordering the materials that need to be ordered? Make sure that they have the authorization to. And then what are they ordering and what quantities and at what price? So once you get the authorization, then you go on to 4, count it. So I order 5 water heaters, 3 toilets, and 2 garbage disposals. Then when that order is delivered to the shop, somebody, preferably somebody besides me, again, separation of duties, checks to make sure that what we receive are 5 water heaters, 3 toilets, and 2 garbage disposals, and that all the items we receive are not damaged, that their boxes and everything are in good shape. And then we also compare the receiving ticket and make sure that we got the items at the price that we were quoted. So the purchase order and the receiving slip match. Then inspect it. Like I said, inspect to make sure there's no damage and make sure that, when you ordered 5 water heaters, that you got 5 water heaters. Then you, to follow up on that, then the next thing you're going to do is you're going to compare the purchase order and the receiving packing slip that they send with the supplier's invoice that comes. So in a PO system, you're going to say, okay, PO 1005 from ABC Supply was for the Smith, the Smith job, and you have a list of orders from the Smith job, or the list of items that you ordered for the Smith job. Then you compare that to the invoice that you got from ABC Supplies for those materials, and you got to make sure that the prices match up, and then you can compare that also to your service invoice. Now, with my family business right now, we have not gotten to the point where we're mobile yet, so we still use manual service invoices and that. But our final step is comparing and matching up our service invoice for, say, the Smith job with the supplier's invoice for the materials we purchased on there, and we compare what we ordered versus what we installed to make sure that there's no discrepancy. Or maybe we ordered say 60 feet of 3/4 inch copper pipe, but we only used 40 feet of it on the Smith job. So then I know by comparing the invoice, the client invoice against the supplier invoice, that I have 20 feet left, which is going into, maybe stays on the truck and goes into truck stock. But I'm comparing initially the purchase order with the packing slip for what was received, comparing that to the supplier's invoice, comparing it to the purchase order to make sure the pricing is the same, and then comparing that to the job ticket, the client service invoice, assuming that that order was for a specific job. If it's just a stock, then you just compare the supplier's invoice and the pricing on that to the receiving slip and to the purchase order. Again, we're making sure that there's no errors. And the error could come from the vendor. And the attempt at fraud or something even could come from the supplier side. So it doesn't necessarily have to be an employee-initiated thing. You could have a situation where you're quoted a price on the PO for, say, water heaters, whatever it is, but then you get the invoice from the supplier for the water heaters, and they're $50 higher each. Well, that could be somebody from the vendor side that is playing games. So my point there is it's not just an employee situation. The fraud could be initiated another way, and frankly, it could also be an honest mistake. That's why you double check. That's why it's important to check, because it could be an honest error, it could be a typo, or it could be something funny. But if you don't make the comparisons of the PO to the receiving order or the packing slip to the supplier's invoice, then onto the service invoice for the client if appropriate. If you don't make that comparison, then you don't know. Now, something that has become more popular, I would say especially I've seen in the last 2 or 3 years, and I know a lot of PHCC members have gone this route, a lot of QSC members and other industry groups, companies, especially the smaller companies like the family businesses that don't necessarily have the staff, so to speak. I talked about earlier about, well, we can't afford a warehouse person per se. A lot of vendors, suppliers have what they call these VMI programs, where essentially the supply house is kind of your warehouse person. And I know that in the PHCC we have national companies like Barnett and Ferguson, among others, that have these programs. But I'm also aware, and if you're not sure in your local area, you can ask supply houses that you deal with. They may have a program that you might not even be aware of, where they would be agreeable. They would say, hey, sure, Mike, I will come in, and I'll help you set up your truck inventory, and then we'll manage that. We'll help you manage that for you. Now, that's a great program, and I know a lot of contractors that are taking advantage of that. But the one thing I have to remind you is, just because you delegate the responsibility doesn't mean you delegate the authority. So my point in saying that is, it's still your responsibility as a contractor, or my responsibility as a contractor, to oversee the supplier or the vendor and make sure that the program is being run or managed correctly. Because you could say, okay, I'm going to bring in a VMI system and let them go with it. Well, if you don't stay on top of it, it's just like you haven't locked up your inventory. I mean, you could have somebody coming in and taking advantage of you that way. So while it's a great program that's available out there, and you're delegating the responsibility, it doesn't mean that you're delegating that, you can't just, you've got to still monitor it or oversee it, I guess is the point that I'm trying to share with you there. Just kind of a little bit of a review here of the process with the materials. This is a slide from that I've used before. on the fraud programs, but it's important to have authorization and approval. Okay, the way that we reduce the chances of having materials or equipment, what have you, stolen is a physical control over the assets. Restrict the physical control of those assets. So lock up your inventory, secure it. Equipment, have lockout, tagout procedures, sign-out procedures. You lock up your inventory, or you have an inventory cage, whatever. You can have the same thing for your equipment. So, say you've got, you don't carry sewer jets on every truck or video cameras like that. You can have sign-out procedures for those, and you can have those locked up in a secure area as well. Electronically, secure access. Note that just like you secure your inventory, you want to secure access to your bank records. Those of you that are doing online banking and things like that, it's important to protect your computer passwords. If you have company key cards that, let's say you're a little bit larger company or high-tech, and you have one of those company ID badges that swipes, that gives you access to a certain area of the building or inventory room, make sure that you're monitoring those and restricting accesses to, who has those key cards, and that you're updating them on a regular basis. Again, restricting areas to authorized personnel only. And then monitoring it, reviewing the records, make sure that the sewer jet was properly signed out. Just an added safety thing to something like that I'm thinking, I know is popular in vehicles, GPS systems. Tracking systems. That way, if something does happen, you at least, have a way of quickly finding out where it is, even if it has been taken or stolen. You may be able to track it down and recover it. So that's what I have on inventory, and I'm going to just take a quick second here. I don't see any questions yet regarding that. But if you have an inventory question, go ahead and type it in the chat box on the right-hand side. I want to take a few minutes now and just, again, remind you, you don't necessarily need to take notes. So, everything that you see on some of these slides have some detailed steps. Don't worry about it. You're going to have access. You're going to get copies of these slides. So, you'll be able to review them and read them later on. But here's some other internal control suggestions for you in other aspects of the business besides the inventory, because obviously inventory is not the only asset or aspect of our business we have. Accounts receivable is another huge area. So that's not just accounts receivable, but that's cash flow, cash coming in, cash receivables, petty cash, all those kind of things. So an accounts receivable, if possible, 2 people should open the mail. How realistic is this? In a smaller company, I know it's harder. It's more challenging. Well, why do 2 people open the mail? So you don't have somebody just pocketing a check, or maybe for very few people anymore send check or cash or a cashier's check in the mail. But you have 2 people opening the mail because, or reviewing, one person opening the mail maybe and another person observing them, because the more people you get involved in a quote scheme, the more likelihood it's got of being discovered. So it might not be possible in a smaller company for 2 people to open the mail. If that's not the case and you have security cameras, maybe that's something that you have a security camera in the office or something where the mail is typically opened. So that's something to consider. You can also, and actually this is something in just talking that popped into my head, is kind of a side note that's not on this slide. Anybody in your company that handles money, from the person in the office to the service techs out in the field, should all be bonded, financially bonded. And what that means is that they're protected, that you have, quote, insurance on them for theft up to a certain amount of money. Federated Insurance is a partner of the PHCC, and that's who we have for our insurance. they have a program where they bond your staff up to a certain dollar amount, which I think is like $50,000. If you've got somebody that's handling a lot of money, you may want to get a separate policy and have a higher dollar amount. But anybody that's touching money for the company, either coming in or going out, should be bonded. That's an important thing. Back to this list. Log and document all monies received. So 2 people there opening the mail, or maybe it's just 1 person because you don't have a second person. So first thing you have them do is open the mail, and they list out all the checks, all the payments that are received. So all the monies that are received, checks, and as they're opening them, they're also immediately stamping the checks with the restricted door endorsement stamp for the company. So no funny business can go on. They can't alter or forge the check because, you've put it for deposit only to ABC Plumbing Company, and then right underneath it is the plumbing company bank account number that it's going to get deposited to. Separation duties, again, is a big thing. If you have the capability, whoever puts the deposit, opens the payments up, should not be the same person that does the bank deposit. So the person that records the list of payments that comes in, and then a second person does the bank deposit and verifies the totals, the money that's been received. Keep the cash, anything that comes in cash-wise, checks, locked in a secure area, a locked box or drawer or something, until you deposit it into the bank. I don't recommend that you keep cash especially, or checks for the company in the office sitting around for very long. The longer it sits around, the more likelihood it's got a chance of being stolen or something happening to it. So if you're a smaller company and maybe you don't make deposits every day, maybe it's every other day. If you're a really large company with I can't see a scenario necessarily where you've got mail delivery more than once a day, but if you were in that situation, you might make multiple trips on a daily basis, maybe 2 trips a day to the bank. But I would say in most cases, daily trips to the bank, unless it doesn't warrant it. Blank check stock while I'm thinking about it. So on the cash disbursement side, make sure that company checks, a lot of us, if you're not doing electronic payments, you've got company check stock, you put in a laser printer to have it print out the check. Make sure that that's secured in a locked area with restricted access. Again, that's another way that you could get money taken from you. But on the deposits, again, make sure you get them in, at least my recommendation is every day, unless it's a really small amount, and maybe you wait till the next day. Batch out the credit cards, reconcile the credit card payments daily. The person that's doing the data entry maybe on the credit card payments as you're processing invoices, that person also should not be the one reconciling the credit card payments at the end of the day if possible. That should be 2 separate individuals. Invoices, make sure that you have them pre-numbered and that they're accounted for, so a batch of invoices doesn't go disappearing. There's been contractors that have had that happen where they've had employees, technicians use company invoices, but they've used them on side jobs and just collected cash. And the homeowner's gotten a receipt and they think they've just had service from ABC Plumbing when it's gone into Mike Bohinc's pocket as the plumbing technician. So invoices should all be pre-numbered and locked up, kind of like your check stock. Any adjustments, any refunds, credits, anything like that should require management approval and sign off on. That way, that eliminates the funny business of, oh, yeah, no, I gave Mrs. Smith a $50 refund when that $50 really went into the person's pocket. So you should have a system where any credits, adjustments like that have to require management or owners sign off on. And if it's a smaller company and you don't have a managerial level, then require that the owner, that you sign off on it for any kind of refund or adjustment. All right. On the payable side, I talked a little bit about it with inventory. Require a purchase order number, job name for all purchases. It's not really, if you don't have a purchase order system, it's not difficult to implement. If nothing else, you're going to go to ABC Supply and get materials for Mrs. Smith's job. When you or your technician goes to the supply house, you just tell the supply house person, when they ask for a PO number, just tell them to put, if you don't have a PO number system, just tell them Smith job. That way you know then when that invoice comes into the office, you'll be able, that's for the Smith job, and you'll be able to attach that to the service invoice and do the comparison. So even if you don't have one, it's not a real difficult thing to set up. All checks require 2 signatures on all payments. If you want to say, okay, any check over $500 requires a second signature, that's fine. I've seen companies that do that. Any check over $1,000 or $5,000 for the real large companies have 2 lines and require 2 different people to sign off on the check. Now, this sounds somewhat contradictory to what I'm going to tell you here, but I would also restrict the number of people who can sign checks for the company. Restrict the number of signers, because especially in the smaller family businesses, maybe you've got 3 or 4 family members. If you want to have 2 or 3 of them have signing authorization, that's fine. But you don't necessarily want to have 10 people be able to sign checks, even if you're a company with 50 employees. There's not, excuse me, there's not a need to have that many people authorized to sign checks. And again, the more that you have to authorize, the more chances that you have for fraud or theft, something to happen. On your credit cards, set your limits, set purchase limits. And you're able to do this with the credit card company. Tell them, no single purchase over this dollar amount, whatever. Those of you that have company fuel cards, restrict the type of purchases allowed. With a lot of the fuel companies now, whether it's BP or Sunoco or Shell or whoever, a lot of these places now, you can't just get gas. You can maybe get an oil change or auto repair truck services. You can also buy pop and candy and that kind of stuff. And if you're not careful, if it's not coded, you're not only paying for the fuel, you could be paying for somebody's pop or, God forbid, something, some alcoholic beverage or something. So make sure that you restrict the type of purchases allowed on your account. The person that enters the accounts payable bills, they shouldn't also be able to authorize or sign the checks. Again, I know that's a little bit harder in a smaller company, but that's separation of duties. You don't want the person entering the, if I call up, again, kind of Ferguson, let's say, and I order something that I shouldn't be ordering, if I'm entering the payables into the computer and I'm able to sign the check off on it, then you never know what happened unless you're reviewing it. So if you can separate those 2 functions, you absolutely should. Company checks, like I mentioned before, should be locked in a secure area. And then I'm not in favor of company having a petty cash account. If you've got what we've got in our family business, most of the time it's not a large dollar amount. Maybe somebody has to run, a hardware store or something because they don't have it on their truck. We just tell our guys, we reimburse our guys. We tell them to, pay cash, get a receipt, or maybe they have a credit card. But I'm not big on petty cash because it's difficult to reconcile, and my experience has been it ends up missing. So doesn't mean you can't do it, but I personally am not in favor of petty cash accounts. Internal controls on payroll, a few items here. Ideally you'd have a time clock or other electronic reporting method to track the employee's time. But if not that, then obviously at least have timesheets or time cards, as that's mandated by law. But compare the employee time cards with maybe 2 guys worked on the same job. Compare those 2 time cards. If they went to the same jobs together that week, make sure they match up. Unless you know for certain that there was a reason that employee A stayed an hour later one day than employee B. If you have GPS on your vehicles, surveillance cameras at the shop, compare those, excuse me, excuse me, compare those records to the recordings and or what the GPS reports say. Also, have a supervisor, reviewer sign off on the subordinates' time cards. So you don't have time card padding going on there. Because you could have a situation where somebody in the office and one of the service techs are working in cahoots, kind of like, hey, you know, I'm going to pad my time card by 15 minutes a day or half an hour or whatever. And then maybe they share that money. So make sure the manager or somebody signs off on all the time cards or reviews them. Again, what's not being watched or monitored or tracked, you know, it's subject to, you know, you're subject to being having a problem. The person employing that you have doing the payroll data entry in that, the same thing, they shouldn't have the ability to approve the time cards or sign the payroll checks. Again, that's the separation of duties, internal control. The smaller companies, again, I know it's more challenging. If you use an outside payroll company, that might be one way around, or that might be one way to help with that internal control, is because you're using an outside payroll company. So that eliminates one of the duties internally. So you're separating one of the duties actually by just having an outside vendor, a third party, handle that aspect of it. And then restrict access to the payroll records. Okay, you know, there's only certain eyes that should be authorized on that. So kind of like the check stock and that, in cash, make sure it's locked up. If you have a system in place for it, you know, procedure, if somebody needs a copy of some payroll records, you've got a process and a procedure for getting a copy of that record. A couple final points here. Code of conduct. You know, when it comes to fraud, communicating the company philosophy, simply the owners and managers set the tone at the top. And the reason I used this slide again was because it was last year or the year before we did a two-part series on fraud. And one of the PHCC members that attended that webinar, we went over this exact point. And I said, if you do nothing else other than go say at your next company meeting and say, hey, you know, just want to let you know that we're not going to tolerate anybody stealing from us or stealing from our clients, what have you. One of the people attending the webinar did that in the first section, and they came back in the second session and they typed in the chat area that they did that, and the day after they did that, their bookkeeper did not show up for work. Now, the only sad thing from a inquiring minds kind of thing, we never did find out from that company or that member because they weren't necessarily identified as to whatever happened. Like, why didn't the employee show up? You know, we could only kind of make the assumption, wow, they didn't, you know, they just kind of never showed up. This was a week later, by the way. So, you know, the day after the first webinar, the owner must have done this, and then that next day the person didn't show up. Well, this was, you know, a handful of days later when we did the second session of the fraud. So that's my point of saying, you know, simply even just doing that, communicating that you won't tolerate it, is a form of an internal control. And I hope that it worked out for that PHCC member's best. I hope that, you know, they weren't subject to a huge amount of loss or something, but something was definitely happening there. Once you put inventory controls in place and these other internal controls in place, you have to monitor them, okay? Make sure that they're operating properly. You know, you can't just put them in place and then forget about them. You got to take a look and review them every once in a while and make sure they're working properly. When I mentioned earlier about the material percentage, well, you know, God, our material percentage is normally 18% of our invoice. All of a sudden it's 23%. What's going on? Well, by regularly reviewing your financial reports, that's one of the ways you can tell you might have a problem. And here's just a portion of a report that shows industry averages for inventory days, accounts receivable days, return on equity, all that. So these are industry benchmarks. Well, if your numbers are way off of this these benchmarks, or maybe way off of previous years or your budget, you know, let's say you budget your fuel expense at 5% and it's running at 8%. Looking at these reports and reviewing these reports could tell you might have a problem. You know, it'll give you a heads up that, hey, you know, somebody could be fueling their personal vehicles, or your material cost numbers off. Somebody could be purchasing materials. Fraud is a legal minefield, okay? And we are plumbing and heating and cooling contractors and work in the office and accountants and things like that. We are not attorneys, okay? And this is a very litigious area. You need to be very careful. So if you find or you suspect that you have a problem, be careful in how you act. Just a few don'ts, okay? If you find somebody stealing materials or whatever, okay, don't immediately confront the person or restrain them, okay? Take a deep breath. Try to remain calm. Don't immediately terminate them, okay? Don't say to the other tech, oh, I saw Bill take 3 water heaters last night. Don't do things like that. Any documentation you find on the originals, don't write on it. Don't interview the suspect. Don't interview the suspect down the road alone. Do it with at least one witness. If you find that you're in this situation, my recommendation is that you contact your company attorney and your insurance agent and your accountant. Those 3 people. Those are 3 professionals that you deal with and that you pay for their services. There's a reason you have a relationship with them. So on the very off, I hope it doesn't happen, but if it does happen, contact those professionals before you make any rash decisions. Your attorney especially will help guide you as to what you can do legally and cannot do and what you should do. So that's a lot to cover in a brief period of time, and again, some of it went kind of fast, but we have a couple minutes left. I'm going to open it up for any questions. I don't see any in the box right now, but I'm going to give you a minute or two if you have something you want to ask me. So go ahead and type it in the chat section. As a reminder, again, Wayne is going to send you a link later to review the webinar, and you will have copies of these slides as well. If there aren't any questions, what I'm going to do is I'm going to go to this last. Here's my contact information at the bottom. If you find later you have a question or that you would like to answer or something specific about your company situation, you can contact me. My phone number is 440-708-2583. It's my home office number. Or you can email me at M as in Michael, and my last name, Bohinc, B-O-H-I-N-C, at keepingscorecpa.com, and I will be glad to answer any questions that you may have. So with that, I'm going to turn it back over to you, Wayne, and we can wrap it up.